Okay, before we head in, let's go through our dates again. July 31st, this is the deadline for the all-included applied level. You have 31 days to get it in under the wire. August 25th will be the last day for new positions in the market outlook that shows up on YouTube. After that, it moves to the applied level in the portfolio construction module. The next sub-industry, ocean shipping, well underway. I've done the dry bulk sector. I've used SBLK as the company example. Moving on to tankers, I'll be using Frontline for that. Then I'll move on to containers, container shipping. In terms of size, dry bulk is the biggest. Tankers are second. Containers, lots of shipping, but it's small compared to the amount that is shipped with dry bulk. But we'll do containers. Was going to use Zim, which is an Israeli company. I just don't know how representative they would be going forward. So I may try to find another company, but they do have a long history, 75 years, and I do like their statements in terms of ease of reading. When I use these companies, I am in no way recommending them. I am not saying that these are the places you want to be. Just SBLK, they, with their merger with Eagle Shipping, now have 161 ships spanning the Newcastle size, which is the largest Cape size, down to I believe they have the upper level of Handymax. So they span a lot of different size markets. So they are representative of the industry. That's why I'm using them, not because I'm recommending them in any particular way. One that I've been looking at is Clarksons. They're not a shipper. They're a broker. They're in the UK. They're a ship broker. That's the largest part of their business, comes from brokering. They also do financing and research, but you know, they get some money from that, but you certainly wouldn't be investing in them because they do that. It's the ship brokering where they get all their money, and a great source of industry research if you're looking to research anything in ocean shipping. Clarksons is a place to be. On a trailing basis, trailing at 15 times previous earnings, earnings about 275. Well, it's 275p, but I'll just write 2.75, trading at around 41 to 42. And this is in British pounds. They're traded on the UK exchange. You may not be able to access them, but they look interesting. I haven't really decided what I want to do with these ones or with this one yet, but that is the one that I've been eyeballing in the UK is Clarksons. I should be done this video week of July 8th. So I will talk about SBLK, Frontline, and some container shipper, and I may introduce Clarksons as a ship broker and talk about the ship brokering model. But as you can see, being that it has three sectors to ocean shipping, it is going to be slightly longer. Dry bulk is by far the biggest sector, followed by tankers. Container shipping is a big part of shipping in terms of finished goods, but in terms of size, doesn't even come close to the dry bulk industry. Okay, there we go. Keep in mind, 31 days. Let's head in. Let's begin by reviewing some of the headline economic data from last week. For those of you in Canada or in the Canadian market, you couldn't have missed this on Tuesday. Canadian inflation came in higher on pretty much every single measure. Core inflation month over month 0.6. The forecast was 0.2. That's huge. The inflation rate headline year over year came in at 2.9. Expectation was 2.6. Previous was 2.7. So you had it coming down. Now you have a tick back up. And headline month over month 0.6. The expectation was for 0.3. This didn't have as much of an effect on REITs as I thought it would. REITs did fairly well that day. Then they had a bad day. Then they had a good day. Then they had a kind of day. But I thought that this would really push REITs down for a couple of weeks at least. And it didn't. So I'm pretty impressed with that. However, I will say with the REITs, There has been, if you've been watching the news feed, there has been a little uptick on talk about the value to be found in Canadian residential REITs. Scotiabank on Wednesday night came out with its two in terms of conviction, and in order, which surprised me really, in order, number one was InterRent. Number two was CapREIT. I thought for sure that should be the other way around, but Scotiabank didn't see it that way. InterRent number one, CapREIT number two. I'm in both of those. Consumer confidence, we also got that on Tuesday. Last reading was downgraded to 101.3. The expectation was for a drop down to 100. 100.4, still another drop month over month, even though it's higher than expectations. Let's not gloss over the fact that it is still a drop. Wednesday, and the gasoline struck me as odd. We had builds in both oil stocks and gasoline. For this time of year, a build in gasoline stocks. Maybe it was a build in anticipation of the July 4th weekend coming up. I don't know. The expectation was for a drop, negative 1.1 million, and you had a build of 2.6 million barrels. And for crude oil stocks, expectation of a drop of 3 million barrels. You had a build of 3.6 million barrels, but oil seemed to hold its own last week. I just find it odd on the gasoline stocks. We'll see how it looks for the next 2 weeks, because we'll get another report before July 4th, and then we'll get another report after July 4th, and we'll see if there was something there, or if this is something happening below the surface that we're seeing in other sectors as well. Well, we see some of the companies that reported last week, General Mills, Nike, weakness, and a Nike weakness, not just in any one particular market, but in footwear across all markets. General Mills, just general weakness. Mexico, balance of trade, look at this. Expectation was for a trade deficit, 1.99 billion, up 2 billion. That is money flowing in to Mexico. That is value flowing into Mexico. Unemployment rate was 2.6, was going to tick up to 2.7, held at 2.6. 2.6% unemployment. That's impressive. Interest rate decision stayed 11%. Back to Canada on Thursday. Average weekly earnings year over year 3.7. Last month was downgraded to 4.1. Still fairly healthy. 3.7, you may think that is fairly low, but let's keep in mind that Canada's productivity for a long time has really sucked. That Canadian firms don't have the same ratio of capital to labor as U.S. firms do, because this is not really a transformation country. It's a raw material country, and it doesn't have much of a tech sector at all. It's got some tech companies in here, but if you really have something in tech, staying in the Kitchener, Waterloo, Toronto corridor, even up to Ottawa corridor, there's not a lot of venture capital money for you. You're heading to Boston, Colorado, Austin, or the big one, Silicon Valley. So there's a drain into the U.S. And without a big tech sector, tech is usually extremely productive. So when you add tech to the mix of all the other industries, it makes it appear that productivity is much higher per employee, because you're taking very high productivity employees. Well, Canada doesn't have that. So because productivity is so very low, this is more inflationary, especially in the services side, than you would expect it to be in the U.S., because you do have productivity that brings down unit labor costs. Not so much in Canada. Thursday in the U.S., 8:30, two big orders. You got durable goods, and you had your GDP final look at Q1, and then lesser importance, you had continuing claims and initial claims. Let's look at durable goods. Previous month was downgraded to 0.2. The forecast was for negative 0.1. Came in at positive 0.1, but let's not celebrate yet. Durable goods, let's take out transportation. The expectation was for 0.2 and it was negative 0.1. The previous month was 0.4. If you take durable goods and you just take out defense, negative 0.2. Previous month was negative 0.5. So transportation carried the day for durable goods. GDP growth rate, our final look. No, you don't get a lot of changes on the final look. Forecast was 1.4. It came in at 1.4. Troubling was the PCE, the personal consumption expenditure price indexes from Q1. 3.6 was the expectation, came in a little hotter at 3.7. And when we look at the headline prices quarter over quarter, 3.3 came in at 3.4. It's historical. You're looking back at Q1, but still not what you'd want to see. Having a look at one more item here from GDP, corporate profits quarter over quarter. The expectation was for negative 1.7, negative 2.7 for corporate profits, and which has to be on the SMB side, small and mid-sized businesses, because S&P 500 met their expectations and exceeded it by 8%. The surprise factor was 8%. So S&P 500 profits held up. It is the smaller the company gets, the more likely it is to be less profitable. We're seeing that in the Russell 2000, which now has the highest proportion of unprofitable companies in it. So I think I said this, I forget how long ago, a year and a half, 2 years ago, that I think that we're entering an era of large firm capitalism where gains will accrue to size, and with technology being deflationary as it is, the other benefit that technology has is diminishing costs to scale. We used to think of the optimal size of a firm. If you think about microeconomics, as a firm gets, it has a bunch of different cost curves, right? And they tend to look like this, so that when you draw a longer term line under those cost curves, you have some point which is the optimal size of the firm. After that, you get diminishing returns to scale, diminishing marginal returns to scale, where the firm just simply gets past some size where every bit bigger it gets costs more to manage. While with technology, you can actually have diminishing costs to scale, so there's no reason why it needs to stop here. It can continue, this curve can continue downward, which means there is always an advantage for large firms to get larger. We could see something like that going on here, because we certainly didn't see that in the S&P 500, but we certainly do see this in the Russell, that economy-wide, at least for Q1, we've had corporate profits that were 2.7% below the previous read, 2.7%. On Friday, we got Canadian GDP, month over month for April, 0.3, came in as forecast. We had our first look at May preliminary, 0.1. There is a drop from the month before. US PCE core 2.6, expectation 2.6, nice drop from the 2.8. The headline 2.6 came in as expected, a drop from the 2.7. The core month over month 0.1 as expected, a drop from the 0.3. Headline flat as expected, a drop from the 0.3. And this is nice to see. Personal incomes for May up 0.5%. Personal spending down 0.2%. That speaks to hopefully some improvement in the household balance sheet if we think about it on average. Don't have the distribution of that, so we don't know where incomes and spending is skewing. It could still be, and I would bet on this one, that it is the bottom 70 to 75%, where the spending is probably equal to their income, if not greater than their income, with most of the distribution creating this outcome coming in the top quartile. Consumer sentiment, 68.2. Expectation was for 65, but the month before was 69, so it is a drop. It still is a drop in consumer sentiment, and this month was a big drop, getting down to 69.1, and after a big drop, you have another drop down to 68.2. Things haven't gotten better, they've gotten slightly worse. Not as bad as expected, but still, let's pay attention to the direction there. Michigan 5-year inflation expectations, I don't even know how valid these are, other than just sentiment from the consumer. I wouldn't think of these as being wisdom of the crowd on this one. 3%, same as the previous. There's no reason why anybody changed their mind, going, yeah, it's pretty much the same. Also during the week, we got a whole bunch of district economic activity gauges. Dallas Fed Manufacturing Index for June, negative 15.1. Tuesday, you got the services, negative 4.1. Tuesday, also Richmond Fed Manufacturing Index, negative 10. Services, negative 11. Thursday, Kansas City Fed Manufacturing Index, negative 11. The composite, negative 8. All of them negative on both the manufacturing and the services. Mind you, it's only 3 districts, but all of them came in negative. Usually have low priority or low importance. Nobody really pays much attention to them. They tend to be small sample sizes, so they tend to be ignored because of that. But when you start aggregating all the small sample sizes from all the feds, you end up with a fairly decent sample size. So if you put all of these together, the sample size is significant enough that I don't know that we can ignore the negative numbers. All right, with that in mind, let's have a look at yields and rates. Money market rates, all well behaved. Capital market yields showing a bear steepener. Doesn't seem like much week over week, but when we see the chart for TLT, we'll see that this happened all in one day. But it doesn't seem like PCE should have done it. PCE came in as expected. There were no surprises that it was coming down faster than expectations, and it's down from the month before. But I think it had to do with a realization on Friday after the debates that neither candidate nor any questions even concerned themselves with the level of debt, the level of spending, the level of deficits, the length of time before you even get to a balanced budget. There seemed to be absolutely no concern about this. And I've made this analogy before. There's nothing wrong with investing in a company that's broken and that has a lot of debt, as long as management recognizes the problem. If management steps in and says, we got a lot of debt, we have to focus on this, then it's not a bad, it may not be a bad investment. But if management does not even recognize that they have a problem, all you can do is sell your shares, because it'll just get worse. Do politicians even recognize that there's a problem? I'm not sure if you've noticed the news feed lately, but there's been a significant uptick in the number of people and the number of places that are now talking about the unsustainability of the U.S. debt, something I've been talking about for quite some time. And I think it was 2, 3, 4 months ago, I forget, but I said, you'll hear nothing about it until that's all you hear. It'll be everywhere all of a sudden, and it is creeping up, just the sheer level of debt. And not just the sheer level of debt. I think the story here is I don't know if it's the unwillingness to recognize it as a problem, or the inability to see it as a problem, but that no one who can control it is actually even talking about it. It's not even a priority on anyone's radar. No one's even talking about balanced budgets. The only politician, I think, that has mentioned the word balanced budget is the Conservative leader in Canada, who is saying that we're going to get back to balanced budgets. That's to be seen. It is difficult for a politician to do something about deficits and debt because their spending is somebody else's income, and what you're doing is cutting somebody else's income. You lose votes, right? It takes a lot of political courage to do that, which has been sorely lacking for how long now? Curve inversion still continues on the 2 to the 10 and on the 3 month to the 10 year. I've said this before, I'll say it again. I simply cannot ignore this. I simply can't come to the conclusion of saying this no longer matters. This is going to matter. There are lots of companies each quarter, at least some that I follow. I look at what their effective interest rate is, and it is going up because their swaps are expiring and they have to renew their swaps at higher rates. So interest rates collectively on large companies are creeping up. If the longer this stays inverted, as each week goes by and more swaps have to be reset at higher rates, this is going to weigh. It's going to weigh on incomes. We're already seeing it with the federal deficit. The interest cost, this is going to blow you away. The interest cost per day is $2.4 billion per day. $2.4 billion. And the Congressional Budget Office expects that to be $4.8 billion, double in 10 years. And that is assuming a certain path for interest rates that the Fed just doesn't seem to want to play along with. The Fed is keeping rates at these levels for a while. I'm still on my original thesis on this, that the Fed will have no choice but to lower rates because you cannot look to Washington for any kind of fiscal responsibility. That's gone. That's gone. So the debt will only go in one direction, which means for affordability, for economic growth, to not extract all the money out of the economy just to pay interest. For that purpose, you're going to have to get interest rates back down. There'll be no choice. Balance sheet runoff, $15.65 billion. I shouldn't say balance sheet runoff, but quantitative easing runoff, or the quantitative tightening, 15.56 down to 6.67 trillion. Balance sheet down 21 billion, so there's a net runoff outside of the securities holdings of another 5.8 billion. Money market funds increased 5 billion, retail down 2.3, institutions up 7.28. They're opposite on a whole bunch of things there. Government down 3.38 in the retail space, but in the institution space up 9.64. Next, FOMC, end of July, 31 days. Coming into this week, we got a light week. Monday is Canada Day, so markets are closed in Canada on Monday. Thursday is Independence Day, so markets are closed in the U.S. on Thursday. So both sides of the border have a 4-day week. We get the June minutes in 3 days, and we have ISM manufacturing 1 day, ISM services in 3 days, and Powell speaking in 2 days. It's a jobs week this week. JOLTS we get in 2 days. The always, again, I don't want to use the word wrong, the always different ADP is in 3 days. It moves markets until non-farm payrolls come out, and then this no longer matters. 5 days, both U.S. and Canada. The only Fed speak this week is Williams, and he wants to really be heard, so he's going to speak Sunday, Wednesday, and Friday. Odds, probabilities for nothing happening, still in the upper 80s, 87.6 from 89.7, and a cut, very low, 12.4%. Heading out to December, things don't look any better. One is either none or one rate cut was 34%. That's increased to 40.3%. Effective federal funds rate still at 5.33. And look at the reverse repo, up 243 billion to 664. That's expected. It's the end of the month and it's the end of the quarter. Next week, I expect this will probably drop right back down again, probably to this level, if not a little lower. TGA down by 37 billion at 744. Reserves down 97 billion at 3.26 trillion at 40 billion runoff per month. He's looking at 3 years before we get to, or they get to 2.5 trillion, which is not their number. It's just my best guess as to where the level at that time, where the level of ample reserves will be. Real rates are up for the week, not as much as nominal rates because the break-even rate increased. For example, on the nominal rate, the 5-year was up 7 basis points, but because the break-even is up 5, the real rate only increased by 2. This I find odd, given the numbers we had on Friday from PCE coming in as expected and a step down from the month before. And even if we take consumer expectations, the forecast in there, or at least the thinking was it would be lower, that this would be higher. Looking at Fed funds futures curve, Q3, end of Q3 pricing in 17.5 basis points, Q4 27.5 for a total of 45 by the end of the year versus the summary of economic projections median forecast being at 25. I think 2 is the right minimum. Minimum is the right minimum. Q1 another 28, 73 basis points. Basically 1 cut per quarter seems to be in the curve. Looking at TLT did fairly okay. Hardly any change week over week until the PCE report. And then down it went, which seemed rather odd. I was looking at it in the morning and thinking, okay, there's no carryover from the debate. And then PCE came out, and then it just seemed to cascade from there. But the talk during the course of the day wasn't about PCE, but was about a sort of a growing consensus that neither leader is going to do anything about the deficit, which seemed to me that it should have happened before the report, or maybe it did with the opening, and then throughout the night expectations of, well, maybe inflation will be better, come in better than expected, and then it came in as expected. It's like, okay, well, we're not going to get any help there. These people are idiots. Maybe that's what the sell-off was. But the negative move on the capital market yields all came on Friday. Implied volatility increased, 13-week implied volatility at 75%. There are premiums in the puts. I didn't sell any puts. I want to see how this falls over into next week. Does this story keep going? Because this is not an easy fix story. If the market starts to center on the level of debt, the cost of the debt, the level of interest rates, and the unwillingness or inability of anybody to see that anybody in Washington to see that this is a problem, this is not something that goes away in a couple of days, because you can't fix that in a couple of days. Something like a hot inflation read, you can get other data, in a fairly rapid response, within a couple of days or a week or 2 weeks, other data from other places that show a different side of the story, but not this one. So I didn't sell anything. July 91 put has 93 cents in it. The August 90 put going out one more month, dropping another buck to the 90, has $1.16. If I were going to do anything, I think it would be out to August. Also, let's keep in mind we have Jackson Hole coming up in August, and the topic there, which I don't think is getting enough headlines now, projecting it out, is going to be on whether or not any of this stuff even works. The effectiveness of monetary policy, because rates have risen dramatically and markets keep hitting new highs, corporate profits keep hitting new highs. You have margins, corporate margins still running at decade highs of 12%. It doesn't seem to have affected anybody. Housing prices hitting new highs. We saw Case-Shiller this week, all-time high again. if in a room with no windows and no news feed, you told a group of economists and even Wall Street veterans that the Fed is going to raise rates at the fastest pace they ever have, 550 basis points up from the zero line, which is where we were before they started raising. We're at 0.2. They were going to do this. Where would you expect the housing price index to be? I don't think a single person in that room would have said, oh, hitting all-time highs. Hitting all-time highs. I don't think anyone would have expected that. So the question is this stuff even working anymore? Has the market become so financially sophisticated in terms of everybody having an instrument to protect themselves or to hedge themselves from almost everything? Have we become so financially sophisticated that this stuff just doesn't work anymore? So it'll be interesting whether they all collectively think that, no, well, the neutral rate is way higher than it is, or unless you have the fiscal, the monetary is just not going to work anymore, and we don't have the fiscal. I don't know what I'm going to do with this. I got to see how it plays out, but I certainly don't want to start selling puts if there's going to be a 3, 4, 5 quarter narrative going on about the unsustainability of U.S. debt. It's the unsustainability. If you have the unsustainability of U.S. debt, you have the unsustainability of all debt, because the U.S. Debt market is the largest, most liquid market in the world, and there is money that can only sit in bonds, and it has to find a home. If it leaves the U.S. market, where's it going to go? There's no other bigger market for it to go into. It will cause distortions somewhere. Money's got to sit somewhere. Now, it could come out of the long end of the curve and squeeze into the short end of the curve, but that would distort money markets. So I guess what we would have to look at to see if that's going on in the U.S. market is if the reverse repo reverses direction and starts heading back up, meaning that money out of capital markets is squeezing into money markets. The Treasury would then have to start issuing more money market securities and fewer capital market securities, because if you issue a 10-year, you increase the supply of 10 years, at the margin increase the yield. So if they shifted to money market securities, they could take pressure off the capital market securities. I don't know. It is right now, like everything else in this market, just one big question mark. It's been a couple of tough years to figure out beta and duration at the level of macro. 30-year fixed rate mortgage down 1 basis point, 6.86. The spread between the 10-year Treasury and the 30-year fixed rate decreased 5 basis points, 257. Housing price index for April up 0.2. Case-Shiller for April up 1.4. That is month over month. And the month before was an all-time high, and up 1.4% in 1 month from an all-time high to another all-time high, 320.419. Mortgage apps up 0.8%. New home sales for May 11.3% negative, and I made a point that is month over month. That is not year over year. Negative 11.3%. Pending home sales negative 2.1%. For corporate spreads, really nothing to see here. IG, no move. AA, no move. Triple B, no move. A little bit on high yield, contracted a bit. And for double B, contracted a bit. The only one that expanded was triple C. New positions. Some weeks, I have no new positions. Other weeks I have a lot of new positions. This is one of those weeks where it's like, there's not a lot going on, and there's a level of uncertainty that I don't like. So I didn't really do a lot. I was looking at Nike, thinking any weakness I'm going to sell some puts on. Well, there was weakness, but there was weakness in its big core product, which is footwear, and in every market. We'll look at Nike and General Mills on the next screen, and Micron. And it got punished. Nike got punished. This is the third earnings in a row where this company got punished. The third in a row. So I thought, This looks like more than just a problem with its product or a problem with the consumer. This looks like a problem of leadership at this point. So I'm going to hold off on selling puts on that. GM did come down. I sold 43 puts for August, 83 cents. I have July 44 puts still. Now I have the August 43 puts. Tesla breached $200 on Friday. Got up to 203. So I added to my short risk reversal. I'm short the 245 call long the 150 put for January 2025. I added at negative $11, so I got paid $11 to add to that. So they had gone up to about 203, and then by the end of the day settled back down to about 196. My thesis on this one is, I think I've repeated it enough times. August 8th, they're going to unveil what a robo-taxi platform will look like, but in no way will there be a robo-taxi. That is going to be years out. Now, they can do what Cruise and what Waymo and what a whole bunch of others in China are doing is a geo-fenced robo-taxi service. Waymo is in 2 cities, and with I think with San Francisco, when I say 2 cities unrestricted, meaning that anybody can use them now. Previously there was restrictions on who could use them. Now anybody can use them. And it's geo-fenced. Tesla has not submitted any application at all to any traffic regulator anywhere about doing the same thing. So it does not appear at this time that they're going to introduce a Waymo Cruise type robotaxi. But you cannot be ungeo-fenced in this. It simply doesn't exist at this point in time. You can't just take somebody's car, say off you go, and it can leave your driveway and drive the city streets with no driver in it. It cannot. You cannot do that. There is no robo-taxi business. There's a robo-taxi, I think, vision, but with no delivery date in the future. Optimus, not going to happen. The idea that you're going to create a whole bunch of humanoid robots to work in a factory, why not just create robots to work in a factory that are specialized for the task being done? Why do they have to be humanoid? That to me seems like a ridiculous thing to do. And that you're going to have one of these big, heavy machines in your home around individuals, around children. One wrong move, one injury, that's all over. And at $20,000, that's not going to be a billion unit market. That's not. These are things that are well off in the future. These are visions, and I think that Musk is serious with his visions. I don't doubt that he's serious, and I don't doubt that he will move towards that vision. But as far as the valuation of this company and where these cash flows are, this is fantasy. It's pure fantasy. It's not going to happen. This is, at its heart, at this point in time, nothing more than a car company with car company margins. The celebration that the shareholders had on the announcement that Tesla will sell a minimum of 100,000 vehicles it currently does not have next year. That the low-priced vehicle, the $25,000 Tesla, projected sales of 25,000 units next year on something it doesn't even have. On something it doesn't even have at this point in time, and it went up like $9 that day, or $7 or $9 or something like that. On the celebration that they're going to introduce a low-priced vehicle with extremely small margins, because that's the deal with low-priced vehicles. And to celebrate that, first of all, it doesn't exist. Second, if it did exist, the margins would be so low on that. And it sort of signals to me that you're not selling enough of your higher margin items, that if you can start to squeeze this in. This didn't seem like a thing to celebrate at all. So that's why I added to that position. ES 55.70, yeah, I shorted again at 55.70 after seeing the reaction of the market to Micron, to Nike, to General Mills, the punishment that these companies got. And Micron, to be honest with you, did pretty good. Growth rate is pretty solid. Margins increasing. They did very well. The problem is they didn't do well enough. Is that there's so much perfection priced in that if you fall short of perfection, even though you do very well, if you fall short of perfection, you're going to get punished. And Micron got punished. I think their forward earnings it's a ridiculous number. I think Tesla has higher forward earnings than Micron, and Micron's actually making the stuff that they're being valued on. Tesla's not even making the stuff that it's being valued on. So yeah, I took another short on the market, 55.70. That's all I really did as far as new positions. I closed ABR, my $15 call. I got my 15 cents for that. I am still short the July $14 call and the October $13 put. I got a lot for the $14 call, so ABR would have to go up a lot from here before it hurt me. It is well above its book value per share. And the move on Friday seemed to be the wrong move. You had a 10-year that was rising rapidly. Usually it will trade in the direction of the 10-year. The 10-year price is coming down. ABR tends to come down. The 10-year price goes up. ABR tends to go up. But you had a big move in the 10-year all in one day, and ABR held its ground and even advanced a bit well above its book value per share, I think. And a higher 10-year, I think, would only lower its book value per share. So good for ABR. Maybe it's finally getting some respect, or maybe it's just the short covering that is occurring. But what I would be cautious about if you are long ABR right now, not that I think that this is a short. No way do I think it's a short. It may be slightly overvalued at this point, but I certainly wouldn't short it. Not with, I think the fee is like 6 or 7% to short it. The caution that I would put out is ABR is known for issuing shares when it trades significantly above its book value per share. Now they do have an at-the-market offering, so it wouldn't surprise me on the next quarterly if we learn that ABR was issuing shares during that period of time, and only then would we know what the level of the dilution would be. But it is known for announcing share issuance when it is trading above, or at least a significant amount above its book value per share, and it is trading above its book value per share based on the last quarter. So that's the one thing that I would be cautious about. It does have a reputation for doing that. Okay, Nike, General Mills, and just a little bit on Micron here. Nike was ugly. Huge drop on earnings. This is the third earnings in a row that they've taken a hit. In 2021, November of 2021, the stock was at 177. 2 years later, December of 2023, it was 122. And that's you got about a $55 drop in there, and you basically got another $50 drop in 6 months, down to 75. The low point they hit March 16th. This is when everything was shut down and the markets were just crashing. Hit a low of 67, had a dividend of 24.5 cents, and now they have a dividend of 37 cents. I don't know if they get to 67. Pre-pandemic, they were as low as $50. That seemed to be about a top for a while, was the $50 to $60 range, sitting at 75 now. Let's have a look at what happened. Footwear is their biggest seller in every market they're in, and North America being their largest market. Then you have Europe and Middle East, China, Asia Pacific, and Latin America. in order of size. The biggest market for footwear, North America down 6%, Europe, Middle East down 5%, China up 2%, but again it's third in terms of size, and then Asia Pacific, Latin America flat. Converse down 18%, but Converse is not as big as Nike. I think overall $500 million versus North America and Nike is in the billions. To be down 6%. Nike brand overall, this is not just footwear but clothing equipment, down 1%. On a constant currency basis, which takes out currency fluctuations, up 1%, and that was a combination of price, quantity, and within quantity the mix. That's not very good, considering where global inflation rates are. If your revenues aren't at least keeping pace with inflation, your quantities must be dropping. But this alone, their biggest market, that is not a good number, not a good look for Nike. General Mills took a dump as well. Sales were lower on lower price and mix and lower quantity. The two big killers here, lower price and lower quantity. Let's have a look at some numbers from the fourth quarter. Sales down 6%, operating profit down 5%, adjusted operating profit down 10%, diluted earnings per share down 5%, adjusted diluted earnings per share down 10%. What is in white is a full year. So this was fourth quarter. This is fourth quarter over fourth quarter, down 6%. Full year down 1%. Operating profit flat year over year. Adjusted operating profit up 4%, but that's holding the currency constant. That's on a constant currency basis. For the year, diluted earnings per share flat and up 6% on the adjusted diluted earnings per share. Again, controlling for the currency. Controlling for the currency gives you some indication of how price and quantity did in terms of that, but you still live with an organization that has to report in a particular currency, and that is the value that accrues to the shareholders. So it was not good. But if you look at what General Mills sells, it sells everything that's in your supermarket. Not doing well. Hard to say it's a General Mills problem because it has multiple brands across multiple categories. So you'd almost have to say it's an every brand problem. But lower, Nike, lower. Nike is, as pure discretionary as you can get. General Mills is as pure staples as you can get. So something is going on under the surface, it seems. Micron took a hit. If we look at their forecast for earnings and we multiply it by 4, I don't have a growth rate in there. I just multiplied it by 4, assuming that we're not going to see much growth out of them. You still get to 52 times forward earnings. That's how priced they were for perfection. If you look at their chart, they had this massive run-up, and then they've come down from that massive run-up. And that run-up was pricing in continued growth, NVIDIA style, where you would say, wow, look at those numbers. And Micron did well. They did well, and they're forecasting pretty decent growth quarter over quarter. I think their quarter over quarter growth was 17%. Year over year was like 100 and some odd percent. But it wasn't enough for the AI hype. It wasn't enough. This should be a warning call for all of the AI fever going on out there. Is companies that are being priced with this are being priced for growth that comes in above growthy growth forecasts. And when it doesn't, when it still is great numbers and great growth, they were priced for godly growth and getting hurt. So Micron is down to 52 times those forward earnings, still quite a bit. Memory has very low margins. Their margins are I think 25 to 26%. I think their forecast for the next quarter had it pushing up to like 33 to 34%, which is pretty good margins for memory. That is pretty good margins. CPUs, GPUs, you're looking at, you can be anywhere from like 55 all the way up to 80% margins. Much bigger margins. Memory, not so much. I don't know that 52 times forward earnings make a lot of sense if you're not going to get if pushing up, or you're forecasting to these kind of margins with healthy 15 to 20% growth quarter over quarter. If that's not going to do it, if that gets punished, 52 times forward earnings seems a little rich on that one. I'd look for more downside for Micron. Okay, SPY did not this week hit any all-time highs. The last all-time high from last week, 548.80, still holds. Forward four-quarter operating earnings, LSEG, down to 252.85. SPGlobal has not updated its spreadsheet, so we'll use the last one of 250.40. Closing SPX of 54.60. We're at 21.7 times forward earnings, pretty much the same as the 21.69. Surprise factor of 8%. If that came in, would put it at 20.09 times forward earnings. Now I'm using the next four quarters, 1, 2, 3, 4. Starting next week, this one falls off and we add this one here. So there is going to be a bump in earnings because this one here is coming off. And earnings each quarter increase, and this one increases as well. So we'll see this number jump up, and that would make this multiple lower. Implied volatility dropping 19% on the 13-week from 33%. 50-day moving average is 525.92, which would be a 3.5% pullback. Not unheard of. Not unrealistic either. And the 200-day moving average, 485, is 11%. A 10% correction would put the index at 490.68. I don't know where the catalyst for this is, unless there is, as we enter earnings, we start to see the guidance not as great, or if the punishment continues that we saw this past week, where if you are not perfect, if you are slightly less than perfect, or if you come in under perfection, you're going to get punished. If that happens, you could get a 10% correction. But other than that, I'm not really seeing any catalyst. But the idea is these are hard to predict what the catalyst is going to be, because the conversation on Monday or Tuesday could turn really negative, and everyone could start saying, yeah, I never thought of that. You're right. And then that could catch on like wildfire, and you could get a 10% correction. But I'd say I would, if I had to bet on one or the other, I'd be betting that you're probably only going to get a touch of the 50-day moving average before you get a touch of the 200-day. Look at this. This week coming up, Wednesday, Constellation Brands is reporting earnings. So say SPGlobal, LSEG, and sectorspdr.com. All of them agree that one company is reporting earnings. They all agree on the company, and they all agree on the date. Look at that. We have agreement. Now, I don't know if it's right. Maybe there's two companies reporting this week. That's the thing. I'm not going to check all the other companies to see who's reporting, but they all agree on this one. So that's good. Okay? That's Mr. Mackey. Normally, Mr. Mackey says, don't do drugs. Drugs are bad. Okay? So I just reversed it. That's good. Okay. And that's it. That's all I got this week. I wouldn't say that I'm undecided on what to do. I'm just on the fence at this point. I have a hard time leaning into more bullish narrative, because where are we going to go from here? And I have a hard time completely falling in the bearish camp, because that has not worked. Even though it would seem logical from a macro perspective, it just doesn't seem to work in terms of how companies have reported their earnings to date. So I'm just following the general rule: when you're this uncertain, hands off the keyboard. So I'm not doing very much. Maybe this week will give me some direction. I don't think I'm going to get much until earnings start the week after, and then we'll see. And it doesn't really start the week after. You get financials, but you really don't get the heart of it. So it'll probably be mid-July before we really start to see how earnings play out. That's it.